This video, is a bit of a different one today. We're going to be going into a book recommendation I personally have been reading, and it may strike as slightly less interesting than perhaps all the hunts for the next stock. It might be slightly less interesting, but I do feel this will massively improve the hit rate of investors that are looking to get serious. And what I mean by that is if you make 10 bets a year or 10 bets every 10 years, and six of those flop, and four of those do, outside, like you smash outside the park, it's at least a 3x in 3 years kind of deal. And the other six sort of perform mediocre, or you lose, and on some of them perhaps you go bankrupt, you lose half, or it goes back break even, or it just sort of doesn't nothing really. And it's for your investment reason. It's not you sort of miscalculate something. I do believe that sort of reading the book Quality of Earnings will improve your hit rate. I've actually got the book here with me. And just to sort of go through the reasoning why is because I believe if you make 10 bets in 10 years and your mistakes go from 6 out of those 10 to 4, well, now you've got an additional, I don't know, 1.5 more winners per 10. So now your hit rate might be 5.5 winners, 4.5 losers as a sort of ratio, right? And this limits your downside and it improves your general upside as a whole, which I think anyone would be willing to take. Of course, it does come with additional work. You have to sort of know the nitty gritty about the company, which you may not always find the most entertaining. It's not always as sexy as sort of looking through the the which stock is trending well, what's the new sector to be in. Is it AI? For example, in 2024 has just been major. Right. I'll sort of go into some of the reasons why. He sort of mentions how management often use little accounting tricks to sort of pull the wool over your eyes, and this can sort of give you a misperception of how the company's doing. So if you just looked at traditional ratios, meaning you just looked at simply forward PE ratio, current ratio, if you simply looked at those, what's the anticipated growth in net income? Well, then you may fall more prone to these mistakes. Where if you know exactly what are the accounting policies they made changes to this year, has that affected net income in any manner whatsoever, and sort of decipher what the true growth or decline in the core business is, I think you'll be much better off. Because if a business, for example, is making $1 a share, $1 of EPS per year, and then it sort of has a 10% EPS growth, so $1.1, but you know that actually 7% of that EPS growth has just come from them changing their depreciation policy, and as a result their depreciation expenses have dropped, affecting net income, then you know as a result that actually the core business has only become 3% more profitable. Now, where would you actually value this business growing 3%, which is essentially in line with inflation, versus a business which is, growing a good amount above inflation at a fairly healthy rate? I think that can often protect you in quite a lot of situations. Additionally, it makes you more skeptical of the quality of management, which I believe is a fair thing to do. So it gives you the book sort of gives you various methods on how to sort of outline this and find this. Other things is sort of like the risk with auditors can often give hidden clues which may not always be known. Sort of the perception regarding like professionals and the news. I think a lot of new investors can fall into this trap, particularly where they sort of believe the media. I've always been told when learning that, and I've always had this memento in my head, which is sort of don't trust the media or do the opposite. Often does really well. I know there's a running joke with Jim Cramer, but I do think there is some truth to that potentially, as a lot of it can be manipulated, which doesn't, it's a bit of the dark side of it, but I do think that's something to be said. There is just conflicts of interest as well. These analysts can also have oftentimes very close relationships with the shareholder, with the management team, and as a result, if they're going to offer any if they're going to offer any sort of stock dilution or any sort of stock offerings or debentures to shareholders or something of that sort, well, they want a piece of that business as an investment bank. They often want to sort of underwrite that and sort of make it's a highly profitable segment. They want a piece of that business. But if you just release a sell report on that business, how likely do you think management are to sort of let you in on that? Or how likely do you think you are to even be able to sort of speak to management and sort of meet up with them and maintain that good relationship? It's highly unlikely. I'm not going to spoil the book too much, but there is a reason why he mentioned at the time 75% of reports were buy reports. And I do think that still holds true today. There are a few other things I can't see in this book, but I think overall this book helps improve your hit rate. As an investor, helps you spot potential mistakes. Yes, there is a lot of digging, and it does take a lot of time to sort of learn and pick up if you've not already been doing it, but it is a good reminder there are certain things as well. One for me, which isn't necessarily mentioned in the book, but I believe is a big one particularly if you're looking into tanker businesses right now. Or sort of mining businesses, internalizing capital can be a big one. I've seen some sort of like gas and oil wells sort of businesses where they internalize capital and actually it looks like they're ridiculously profitable. But if you just calculate the net income on that, they're burning through cash at a highly significant rate. They're losing money. And so even though it's showing as a P ratio of 2, the balance sheet looks extremely healthy because, again, internalizing capital means that, for anyone that doesn't know, your interest costs, so just the cost on interest to borrow money, so let's say it's at 6%, that 6%, instead of being added to an expense, which it normally is, because of the reason that because of the way wells are developed and whatnot for the longer term, they're allowed to, by an accounting trick, essentially to add that cost onto the value of the assets. So now the well is worth 10 million rather than 8 million it was last year. This can do two things. It makes a company seem profitable when it's not, in fact, or much less profitable. Or number two, it makes the assets seem much more profitable. So quite often what happens is business seems more profitable, trades at unreasonable valuations. 2, assets end up getting written off and you just end up getting burnt that way. There are 2 things to take into account if you're looking into those type of businesses. And these are some sort of things that sort of get mentioned in the book. Of course, this book doesn't contain everything. It wouldn't have the room to contain everything with how big and grey the accounting guidelines can be. There is often mention as well that 3 accountants get interviewed for the job. They get asked to fill out these the filings for this company, and only one of them gets the job. Well, the first 2 said that the earnings for that business were $2.30, the second $2.40, and the third said, well, actually, how much do you want the earnings to show? Because there's a whole range of tricks that you can do, from whether you depreciate it one way versus another, or from how you calculate inventory as another thing. So these are things to take into account when looking at businesses, and being able to improve your strike rate in the long term will provide tremendous gains and will sort of compound on top of itself, particularly as you get better at the skill. That's it for today. Thanks for listening.